You finally paid off that old credit card you've had since college. It's been sitting around gathering dust, so you decide to cancel the account and clear out your financial clutter. But 3 weeks later, you check your credit report, and your score has dropped by 40 points, and you have absolutely no idea why. This is the responsibility trap. You did what felt like the right thing. You paid off a debt and cleared away an account you didn't need. But the banking algorithms don't see it that way. What looks like good housekeeping to you looks like lost history to a bank. To the algorithm, erasing that account doesn't mean you're organized. It means you've wiped away years of proven reliability, making you an unknown and therefore a higher risk. Your credit score doesn't care about how tidy your wallet is. It cares about how long you've been in the game. If you want to avoid being mathematically punished for good financial behavior, you have to understand how this scoring logic actually works. Your credit score is essentially a grade for how well you handle borrowed money over time. A massive part of that grade, roughly 15% of your total score, comes down to a single category: length of credit history. Think of your oldest credit card like the anchor of a ship. If you've had a card for 10 years and your newer cards are only 1 or 2 years old, that single 10-year-old account is doing all the heavy lifting to pull up your average age. Closing that anchor card tells the credit bureaus to stop counting those 10 years of reliability toward your active profile. The closed account stays on your report for a while, but it stops aging the moment you kill it, stunting the growth of your entire history. This matters because lenders and scoring models track a specific threshold: 5 years. To get the lowest interest rates, most lenders require an average account age of at least 5 years. If you close that old card and your average age drops below that 5-year mark, you aren't getting a clean slate. You're destroying the foundational track record you need to buy a house or finance a car without paying thousands extra in interest. But there is a second, much faster way closing an old card hurts you, and it involves a little bit of math that trips almost everyone up. This is the utilization math trap. Let's look at a baseline scenario. Say you have 2 cards. One has a $2,000 limit and the other has a $3,000 limit, giving you $5,000 in total available credit. If you carry a $1,000 balance on one of them, you are currently using 20% of your total limit. That low ratio looks fantastic to banks. It proves you have access to money, but you don't desperately need to spend it. But watch what happens if you close that $3,000 card simply because you don't use it. Your total available limit suddenly drops from $5,000 down to $2,000. Your actual debt didn't go up by a single penny, but that exact same $1,000 balance now eats up half of your available credit. Your utilization just doubled instantly. Now, you don't have to keep every single account open forever. It is perfectly safe to prune the bushes, meaning you can cancel a younger card that has a tiny limit without much consequence. You just can never cut the anchor. Your psychological instinct to clean up accidentally shrinks the size of your financial safety net. To the algorithm, your current debt suddenly looks twice as risky, and your score drops. So what do you do if your oldest card charges a heavy annual fee or carries a terrible interest rate? You obviously don't want to keep paying for something you never use. This is where the single most underused tool in credit repair comes in. It's a loophole known as the product change or a downgrade. Instead of hitting cancel, you call the bank directly. You ask them to swap your high-fee card for a basic, no annual fee card within that exact same institution. The physical piece of plastic changes, but in the bank's internal system, your account number and your original open date stay exactly the same. You get rid of the monthly cost, but you preserve all 10 years of your credit history. This preserves your history while removing the annual cost, allowing you to clean up your wallet without a score penalty. If you already have a no-fee card but you just ignore it entirely, you face a different problem. Banks will eventually close the account themselves after 6 to 12 months of total inactivity. To prevent this, you can use something called the sock drawer strategy to keep those older accounts alive automatically. You take that old card and attach one small recurring subscription to it, like a $5 streaming service or a minor utility bill. Then you set the card to auto-pay the full balance from your main checking account every single month. After that, you physically put the card in a sock drawer. Hiding it prevents you from using it for daily spending, but that tiny automated charge satisfies the bank's activity algorithms forever. Before you take any action or push any cancel button, always check the age of your oldest account. Ensure your total average age remains above that 5-year threshold before making any changes. The modern credit system doesn't reward a blank slate. It rewards a long, proven track record. Keep your anchors secure. If you want more simple money tips that save time and skip bank jargon,